And good afternoon. Thank you so much for joining us once again and making us part of your day today. This is Market Talk. I'm your host, Jesse Allen, and great to be with you here once again. Merry Christmas to you and yours as we are closing in on Christmas Eve and Christmas Day here to wrap up our week. Hard to believe that we are already at that point and we're almost to the end of 2021, but nevertheless, we are there. Find us online. MarketTalkAg.com is our website. Find all of our streaming sources there: Spotify, Apple Podcasts, Amazon. So many ways to listen to the show. YouTube, our video feed. Also, find all our social media links up there as well. The latest agriculture news and much more. It was another strong day throughout the ag commodities, both grains and livestock. A lot of follow through and continued buying from yesterday's action. We have a ton to discuss, and let's do that with our good friend Mike Zuzolo with Global Commodity Analytics joining us here today. Mike, great to have you back on, and Merry Christmas to you, sir. How are you?
Merry Christmas to you, Jesse. I hope you and all the great listeners and viewers out there in Market Talk land have a blessed Christmas holiday.
Well, we hope you do the same as well. Let's
Thank
get
you.
right to it, Mike. Plenty to discuss. A lot of positive money flow into the markets again here today on the ag side. And a lot of it was deja vu a Tuesday. I mean, soybeans, the whole soy complex, and then our winter wheat, Chicago, Kansas City wheat are upside leaders here on the day. Just your initial thoughts to all the impressive moves and core above $6 at the close too. So a lot to unpack here.
Yeah, I mean, we can go back to last week's close and the ability of the lead month corn and beans to close above some key technical resistance levels, some levels not tested since June, July of earlier this year. 589.5 was the magic number for the corn chart people. There's a gap now at 619.5 that probably people are looking at in the technical side, and getting above that 1289, 1290 level in the lead month beans really opened the door up with a potential gap filling up around all the way around 1370. And there's a 200-day moving average there as well. So that set the stage. All we needed were the fundamentals. And we had the weather fundamentals kind of wobble on us at the end of the week. Those came with wetter conditions. And those came back around on Monday, but we still had the missing link of COVID. And that's our big demand play right now, Jesse. And I think you hit it on the nose with the similarities of Wednesday's trade with Tuesday's trade and what changed between Monday and Tuesday on the demand side, investment demand and expectations of demand, was that we saw a big study come out that Omicron variant probably has 80% less likelihood than Delta to put us in the hospital. The story I read, and I checked a couple different sources, did not distinguish between vaccinated and unvaccinated people. So that even makes it sweeter if it doesn't matter whether you have been vaccinated or not. When you have 80% likelihood, another study came in, 70% likelihood, less likelihood be of severe COVID with Omicron. And then that kind of dovetailed into the idea that FDA just on Wednesday approved their first COVID pill that you could take early on, almost like a Tamiflu, where if you get to the hospital or the clinic fast enough, you've got a chance to really beat down the COVID, it sounds like. And so that was, to me, the secret sauce, the fundamental driver on the demand side that let the investors come back in and come back in a big way, probably allow us to finish up very, very strong as we go into the end of the year, as we go into next week's trade. So we still have weather on the supply side, and that was magnified after we turned drier in South America. We turned back drier for the hard red wheat belt here in the United States. And with that being damage done in the hard red wheat belt from last week, since you and I didn't get to speak, I've got pretty good, significant, conclusive evidence that we've got some damage on the plate when it comes to hard red wheat country if it doesn't get some rain soon. But I think most importantly was the bean oil market. It came back around because of these terrific floods that we've seen in Malaysia. Southeast Asia is getting floods not seen once in 100 years right now, and they're literally shutting down Panasonic plants in Kuala Lumpur, Malaysia. So bean oil has been, and palm oil has been kind of red hot again. So you've got both products coming in and supporting the beans. So these supply demand factors are being priced into the trade, and it's nice to see that happen.
Well, let's unpack some of this. And I want to stay first on the weather story. Let's look at South America. And I know we are turning drier in South America. I know Dr. Cordonier came in, I believe, earlier this week, dropped his production estimates for the South American crops. So, walk us through what you're hearing from your South American counterparts just with the condition of their crop. Because as we know and we're seeing, that's having a big impact on our market trade. And it will here as we get into the first part of next year.
Yeah, real good point here to be made. And thank you for lining it up like you did, because I think there is a distinction in the crops between corn and beans in the trade's mindset. And that's maybe why the corn's been a little bit more disappointing in terms of rallying or not rallying as much as the soybeans and the wheat at this stage. Obviously, we have a lot more managed money longs in the corn. So it's probably going to be harder to attract new money with 300,000 plus net longs of managed money in this contract, in this complex. But this map is an 8 to 14 day precip forecast by NOAA, and it shows the key areas that are the driest in Argentina in red and the key areas that are driest in Brazil, which is southern Brazil. Paraná is the epicenter of the driest areas of all of South America. That happens to be in southern Brazil, so it'd be within that purple circle. Doral came out, that's the Paraná State Ag Agency, came out this week and cut in 1 week the good conditions for both corn and beans 12 to 14 points, so that you've only got roughly 60% corn and a little under 60% beans in good condition at this point. A massive drop, and it shows the damage being done in southern Brazil. Now, what I did for clients here, and I wanted to share this with the viewers on Market Talk, was I think this map shows you why the corn's not being bought, because southern Brazil is not the big corn area. It's Argentina and northern Brazil, Mato Grosso, northern Brazil specifically. That's where all your second crop corn is grown. So it can trim the corn, but if it's only Paraná, it's going to hurt beans a lot more than corn in terms of production. So right now, I think the trade sees it a lot easier between the crush margins, the bean oil issues, and palm oil issues in Southeast Asia I just discussed, and now these weather maps really tuning in and fine-tuning a hit to the bean production, whereas Argentina looks like it could, continue on at least an average crop. We got to remember, Argentina is, number 3, number 2 corn exporter in the world pretty much every year, and sometimes it can go number 1 when we have a bad crop. So I think this is what's going on in the trade right now. I'm of the view that we've got some continuing declines in the crop, but we're not quite there yet.
Let's stay on soy production for Brazil and Argentina and walk us through this chart and what you're seeing here, Mike.
What I liked about doing this chart for clients and subscribers this week on the blog post was showing from 2006, 2007, what Brazil and Argentina have been able to do. This chart, obviously, of soybeans, and the next one will shows of corn. But this shows you how much Brazil and Argentina have grown in soybeans. And it really shows you in the last 15 years, it's been all Brazil. Argentina has really not grown at all, going all the way back to 2006. And that's really amazing when it comes to the soybean production history, when it comes to South America. So it really is all about Brazil at this point. So what I've done is I've come out with my first estimate. It's going to be down around 141.5 right now, Jesse, in terms of million metric tons. That's the purple line. And that compares to USDA's top red line of 144 million metric tons. Now, what I told clients and subscribers this week was if we stay dry as we go forward here through the holiday, I can start cutting Brazil's soybean production about 200,000 metric tons a week, not just because of the dryness in southern Brazil, but also the excess moisture that's starting to crop up in northern Brazil and what that could be doing to the quality and the issues with the soybeans and delaying the second crop corn planting. So this is a really neat chart because I'm going to keep updating this chart, and clients and subscribers will keep seeing how much this, almost like a red line on a RPM gauge of where we're at. Can we get to 144? And look at that 144 sticking way out there that USDA has. That is a big jump versus last year, and it just seems pretty lofty at this point.
How about the corn chart? Let's flip over there and talk to us about what you're seeing there for South America, Mike.
Yeah, very similar chart, but we notice in the corn, Argentina has really come on strong with Brazil. And this is why, again, I think the corn, it's harder to get a corn rally out of South America because both countries have really built a nice base since 2006. So on the corn side for Argentina, I'm at about 51.9 million tons. That's really close to the 5-year average. That's the green bar on this chart, Jesse. And then the purple bar would be the Brazilian crop at 115.5. I'm below where the USDA is on that as well. And I could see that being trimmed a little bit more. And if we stay wet in Mato Grosso during this next 30, 60 days, that could be trimmed quite a bit more. But again, it's a really nice gauge to kind of show you how hot you're running on the RPM, versus where USDA is right now.
Real quick, corn breaking through $6 overnight, closing above $6 here on Wednesday. How good is that for the psyche of the corn market, do you think?
I think it's healthy. I think it's going to attract some attention by farmers to sell after the first of the year. But Jesse, I tell you what happened. It was almost like a gift to the analysis on Wednesday. The Biden administration came out and said we're going to change the CAFE standards on gas mileage. They're going to go from 38 miles to the gallon to 55 miles to the gallon by 2026. They're almost doubling the CAFE standards in 4 years. And so the trade saw that. And I think between the unleaded gas going negative and the trade getting it when it comes to ethanol blending and just pure consumption of ethanol above the blend wall, it's just not going to happen under these kind of CAFE standards. So I think this is the big thing in 2022, whether it's corn, beans, or wheat. Weather, supply, they can be our friend. But the demand side of the equation, you have to assume a defensive posture, especially when it comes to what I call the two gray rhinos. And a gray rhino is different from a black swan. I know you said quickly. I'll try and get through this quickly. Gray rhino is different from a black swan. Black swan you don't see coming. A gray rhino is a term that was created a few years back that says we know about it, we know it's serious as a factor, but we ignore it. We just try and walk past the graveyard, whistle past the graveyard. So the gray rhinos for me in 2022 are policy by governments like this CAFE standard or China and Russia, geopolitical issues, and especially China. I'm not as worried about Russia, but I'd have to put it on my radar screen because of what Jimmy Carter did with the Soviet Union by cutting our wheat exports out when we got into an issue with them back in the 70s, late 70s, early 80s.
Well, let's segue to wheat and a couple issues there. And you mentioned Russia, and I know there's possibly some issues looming here with Russia, Ukraine, and that could affect the wheat situation globally, but also weather here at home on the wheat side through the plains. I know we saw that damage, and we're still assessing a lot of that damage. Talk about some of these geopolitical factors and weather issues here at home that are helping out this wheat market here recently.
Yeah, the weather is our leader to the upside, and the geopolitics is going to be our leader to the downside. And what can negate that is a softer, depreciating US dollar. And it was really interesting to see Ukraine come out Wednesday and suggest that they may start to curb their wheat exports in the first half of 2022. That's because of inflation. That's because their exports year to date are up almost 30%. And Ukraine and Russia are running even hotter in terms of inflationary pressures than we are. And we got to go back in history and into economic theory and realize when prices are high, domestic prices are going to go higher if you export more of your food out the door. So if you want to keep food prices contained, you got to limit your exports. And that we're right in the sweet spot, or kind of the fat of the curve right now, with governments and central banks wanting to battle inflation. So it's a very strong, healthy situation for the commodities right here, right now. And it matches up with what you and I have talked about earlier. Wheat leads. Wheat's probably going to be the first to top. And I would say that wheat needs to be hedged along with beans in the first half of the calendar year, more aggressively probably than the corn market.
Well, on the wheat side as well, and I mean this goes even over to soy meal too. But the demand for cash hard red winter wheat, it just seems like it's a thirst that's not getting quenched. It can't get quenched right now, and I think that's another factor to look at too, Mike.
You're absolutely right. The race for protein, the battle for protein is not going to go away in the next 2 or 3 months, but it's kind of like the supply chain, Jesse. I think within 6 months, you're going to see it ease quite a bit. And on that note, I've seen more container trains and intermodal trains go through Atchison than I have in the last almost 10 years I've lived here. I've seen probably 3 or 4 a day. I've seen engines in the middle of the trains pulling extra cars. I really do think the supply chain's starting to free up when I look at the infrastructure moving through our area, which is kind of the east-west center of the east-west movement for intermodal traffic. So I think you kind of think about wheat and the supply chain the same way when it comes to your 2022 marketing plan. And I think it just goes back to the same thing. The guys in hard red wheat country, I'm going to do a lot more paper positions for when I hedge than the guys in soft red wheat country. That's just the basic, terms and features of what's going on in the crop right now, because I think it's going to be really hard to get a 40 bushel average out of the hard red wheat crop because of what's happening from West Texas all the way to the Nebraska border right now.
Well, not even just the dryness, but the winds that came through the region as well. And I know you're in Kansas, you're pretty close to a lot of that, and I know you probably heard firsthand just some of the devastation that's been seen across the plains here last week with those storms.
Yeah, I sent a lot of pictures out late last week. Unfortunately, cattle and wheat decimated at this point. And we here in Atchison, after the front went through, actually had so much smoke we couldn't see outside. And it wasn't from a woods in the backyard on fire from a lightning strike. It was from the Oklahoma wildfires. I'd never experienced anything like that before in my life. So I think this is, they say wheat has 9 lives. You can't kill wheat. I don't buy it on this one.
Well, you mentioned cattle in there as well, and I think we'll segue over to livestock. This cattle market here this week, cash trade's been fairly poor, I'll say. I mean, we probably expected that with the holiday week, but looking at cattle, strong moves on the futures and hogs too, for that matter. Seems like a lot of positive sentiment coming over from grains in the outside markets. But on cattle, we do have a cattle on feed report coming up on Thursday after the close. Talk about what you're seeing in the cattle market and give us your thoughts on that upcoming cattle on feed report.
Well, you and I have been talking about how this cattle market was maybe running ahead of itself, thinking only about the supply side, and the demand side was maybe taking a back seat, or that it was getting ahead of itself with expecting a really strong demand surge. And we did get that for a couple of weeks with the cash market really rallying sharply. But we paid a price for that. And the National Restaurant Association came out with some fresh numbers, and they saw that the last 3 or 4 months of physical sales in restaurants, whether it's fast food or fast casual, they actually went down 0.1% versus the prior year at the same time period. So my fear has been realized that these high prices are not increasing demand. They're at best keeping the demand the same as last year. So that puts the onus back on the supply side. And that's why this cattle on feed report is so important. If you notice what the trade is saying, is they're saying, look, we're going to go back down to 100% of on feed. That's the average number. I don't necessarily buy that, because we've been running above a year ago levels for a couple, 3 months now. And I'm more in the camp that we're going to be above 100% on feed. So that puts more pressure, especially if we have bigger placements than the average, like I think we probably will. And that's coming straight from the cattlemen. I mean, these cattle guys are really moving their cattle. Why? In part because the corn price is so cheap. So they're moving them into the feedlots. They're not getting stung by high corn prices yet. And you've seen that with 6 pounds increase in dressed weights on the slaughter level in terms of market ready cattle, Jesse, on the weekly production sheets. And so I think the placements are going to be a little higher than the average trade guess. And I think the marketings therefore need to be at least 104.4. I've got them close to 105. What I really need is to see strong marketings numbers to offset what I think is going to be ample supply. Otherwise, the trade may realize what you just said. We're kind of past the holiday seasonal. Why not take this down a little bit more? Why not have the funds liquidate a little bit more as well?
On the hog side, I know as of showtime, we don't have the cold storage numbers yet. They should be out here momentarily before we wrap up. But we also have a hogs and pigs report coming up on Thursday. This hog market, does it feel like we put the seasonal bottom in this hog market, Mike? What do you think?
I would say that as long as we find a bottom in the hams. I've been really disappointed with the ham prices going down near $60. Our low last year was right at Christmas at 57, and that was almost a 2-year low at that time period, Jesse. And so I've really been disappointed with the cutout and led by the ham market during this seasonality. But the thing about the hogs and pigs report, I think, could bring us back around, especially with Taiwan saying they're going to start taking U.S. pork again now, is the idea that we've got 97. The average trade guess is 97% all hogs and pigs. If we come in with that, I think the trade would say, hey, we're shrinking the hog herd now. It's doing its job. We don't need to put any more pressure on it. But if we come in at the top end of the range of 99 plus, we'll probably have to keep pressure on this market. So I'm trying to get back to 80, 85 to get hedges in place, looking for that hogs and pigs to give me that.
Well, Mike, programming notes for our listeners, not going to have shows next week. I'm going to take a well-deserved week off and get a little R&R in. So with this being our last show of the year, any final thoughts for our listeners as we head to 2022, Mike?
I think the key is what we talked about today and what we've talked about the last 3 or 4 months, Jesse, is the dollar really is our best inflation gauge. And keep in mind that this is a supply weather driven market. That's been proven over and over again. Unless we get policy shifts or a new demand, US China trade negotiations go well at the end of this year when the phase one goes off the board. These are the things that we really need to keep these kind of elevated prices going if we don't have Mother Nature helping us. So use that accordingly in your risk management.
Well, Mike, I know as well folks can learn more on your website, globalcomresearch.com, and they can sign up for your free trial. And I just want to say again, I appreciate all the time you've dedicated to being on the show this year. And I really appreciate your analysis and insights, sir. And I look forward to having you back on as we get into the new year. I wish you and yours a Merry Christmas, and we'll talk to you in 2022, Mike.
That sounds great. And Jesse, I want to let you know, Market Talk with Jesse Allen has been one of my highlights of 2021. I really appreciate you and all you do.
Well, I appreciate it. Mike Zuzolo, Global Commodity Analytics, our guest today here on Market Talk for this Wednesday, December 22nd. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon. We'll talk to you tomorrow.